Ladies and gentlemen, good day and welcome to the KEI Industries Q2 FY21 earnings conference call hosted by Edelweiss Securities Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Manish Agarwal from Edelweiss. Thank you and over to you, sir.
Thank you, Stephen. Hello and welcome you all to KEI's Q2 earnings conference call. We have with us from the management Mr. Anil Gupta, Chairman and Managing Director, and Mr. Rajiv Gupta, Executive Director of Finance. I now hand over the call to the management for brief opening remarks, followed by the Q&A session. Over to you, sir.
Good evening, ladies and gentlemen. I am Anil Gupta, Chairman and Managing Director, KEI. Along with me, Mr. Rajiv Gupta is there, Director Finance and CFO. Good afternoon, everyone, and welcome to this conference call. Before I brief you about the financial performance of the company in Q2 and H1 of financial year 2020-21, I would like to give you a brief outlook about industry and present demand scenario. In the domestic business of wires and cables, B2C, that is retail segment, has done very well in Q2, and we have witnessed improved demand in comparison to Q1. Q1 was sluggish mainly because of the lockdowns in April and May, and then it was started slowly opening up. We are bullish about the performance of the company in retail segment during 2021. Our dealer and distribution network, we are pursuing our dealer and distribution network and pursuing additional market channels. In addition, we seek to gain further penetration and consolidate our position in geographies that we currently serve. We will also continue to deepen our engagement with our channel partners and influencers, including getting our products approved from architects and consultants to serve our customers effectively and efficiently. In this regard, we'll be increasing penetration of dealers in the unrepresented areas, semi-urban areas and rural areas across pan-India, and also will add more dealers in metros and urban areas. Government schemes for affordable housing, healthcare and education are expected to gain momentum, which in turn will lead to increased demand for cables and wires in the retail market, in house building as well as the construction sector. We aim to grow our retail segment with the twin goal of diversifying our revenue streams and strengthening cash flows, as it offers higher margins and requires lower working capital due to faster realization and lower inventory of finished goods requisition compared to other business segments. Now, I'll come to B2B domestic institutional business of wires and cables. This has also witnessed growth in Q2, and we are hopeful that same trend will continue in forthcoming quarters of current year and years to come. With the unlocking of most of the economic activity during Q2, we see demand firming up in the subsequent quarters. We are witnessing investment in railways, metros, highway projects where a lot of undergrounding, removal of overheads to undergrounding takes place, power transmission and distribution projects, construction sector, especially the hospitals, investments in the various building projects, airports, etc. We also are witnessing a good demand coming up in expansion and modernization of chemical and fertilizer projects, as well as some construction, some improvement and construction in refinery projects for fuel upgradation. It will boost the manufacturing sector, and it is bringing more demand from the manufacturing sector. Exports. As part of our focus on increasing exports, we are working on developing many new markets for exporting our products. There has been a little halt in our activities because of COVID-19 and restrictions in traveling outside India. But oil and gas projects, which have been our major revenue segment in Middle East, is witnessing little slowdown due to travel and due to execution challenges. But in the quarters to come, this activity will also pick up and will be bringing increased demand from this sector. In B2B segment, particularly extra high voltage cable segment, we have done well. We have improved our sales compared to last year, as we face lesser competition currently, as only few companies in the world have established capabilities to manufacture such cables. Stringent pre-qualification requirements for meeting tender conditions and securing product approvals in extra high voltage cables further make it difficult for new players to enter the market. We are happy to announce that we have now taken our product capabilities up to 400 kV by securing a 150 crore 400 kV voltage grade underground transmission project from Tamil Nadu Transmission Company, and this project will be executed during the calendar year 2021. The cables are already under production. In EPC business, where we take up underground cabling projects in distribution sector for distribution strengthening. We'll continue to focus on completion of existing projects and focusing on closing the projects with money recovery, while capping the turnover size in this vertical maximum up to 500 to 600 crores per year from the previous year's level of rupees 1000 crore. This will free substantial amount of money into cash flows by improving the debtor cycle. The government's thrust on converting the overhead electric grid network infrastructure to underground infrastructure in certain cities and development of smart cities infrastructure is also leading to an increase in the demand for underground cables. Increased infrastructure spend by government will boost demand for wires as well as cables. Aided by a slew of recent reforms, construction spending is also expected to pick up in such sectors such as railways, roads, urban infrastructure, including metros, airports in the major cities, and renewable energies, mainly solar, leading to higher demand.
Participants are requested to please stay connected. The line for the management is disconnected. Participants are requested to please stay connected. We are reconnecting the management. Thank you.
Okay. So I will again start the result summary of Q2. The net sales of the quarter 2 of financial year 2020-21 is rupees 1036.94 crore against same quarter in the previous year, rupees 1230.16 crore. Revenue declined by 15.71% year-on-year this quarter, as against 31.08% year-on-year we have seen in Q1. The total wire and cable business of the company has reached 87% in Q2 and in 82% level in H1. If we talk of our domestic wire and cable business, we have achieved 95.7% in Q2 as compared to last year same period. This was possible because of the strong network KEI is having, who are catering diversified segments and diversified customer base with strong product range from wire to EHV up to 400 kV. The fall of 15% in sales is mainly attributed to fall in the EPC sales and a reduction in exports. It will be pertinent to mention that last year we have executed a very large single order of exports from Dangote Oil Refinery, which was a 400 crore order, and due to which the export sale was disproportional. We could have done better in exports, but due to pandemic, a lot of activities and ordering has come down from the overseas markets, and we are not able to travel because of the flight restrictions. However, we have seen increased EBITDA margins. EBITDA in this quarter has improved to 11.76% as against 10.28% in the same quarter. In figures term, EBITDA this quarter is rupees 121.97 crore against rupees 126.5 crore in the same quarter last year. So EBITDA declined by around 3.58% due to reduced turnover, but the EBITDA margin has improved by 1.5%. Profit before tax this quarter is rupees 92.83 crore against same quarter in the previous year, rupees 77.28 crore. So the profit before tax increased by 20.12% year-on-year this quarter. Profit after tax this quarter is rupees 68.21 crore against rupees 76.17 crore achieved in the same quarter of last year. Profit after tax was higher in the previous quarter due to reversal of income tax provision of Q1 during financial year 2019-20. Profit after tax margin is improving EBITDA and reduction in financial charges. PAT margin is 6.58% as against 6.19% in the corresponding period last year. We have the sales in the institutional cables side. Domestic achievement is 409 crore in second quarter as against 436 crore in the same period last year. So the sales in the B2B segment of cable is declined by 6%. So we have achieved 94% level. However, the sales through distribution network we have achieved 92% of the last year level. So we achieved 348 crore as against 355 crore through dealer network in this quarter against earlier quarter in the same in the last financial year. The sale through distribution network is around 34% of the total sales of Q2 as compared to 29% in Q2 of last year. The total acting working dealers of the company as on 30th September 2020 was 1600. The sales of extra high voltage cable up to 220 kV this quarter is rupees 102 crore against 95 crore in the previous year same period. Growth is approximately 7%. The export sale is declined, which is against rupees 235 crore. The export sale in this quarter is rupees 160 crore against 235 crore achieved last year, declined by 32%. Similarly, the EPC sale is rupees 133 crore against previous year same period rupees 201 crore. So the EPC sale declined by 33.8%. This was a summary of Q2. Now I will come to the sales of H1, the first 6 months of this financial year. Net sales in the first half of financial year 2020-21 is rupees 1,782.24 crore against 2,311 crore last year. Sales in the H1 is declined by 22.9% due to lockdown and restrictions of business activities caused due to COVID-19 pandemic during the first quarter. EBITDA in the first quarter is 202.84 crore in the first half, against rupees 245 crore. So decline in EBITDA is around 17.42%. EBITDA over net sales in the first half is 11.38% versus 10.63% in the same period last year. So EBITDA margin has improved due to conscious efforts of reducing expenditure and better product mix. So the profit after tax in the first half is rupees 104.44 crore against 121.98 crore. However, PAT/net sales is 5.86% versus 5.28% over the corresponding period. The sales of extra high voltage cable in the first half is rupees 190 crore against 173 crore in the first half of last year. The growth is approximately 10%. And export sale in first half H1 is 343 crore against 347 crore in the last year. The export was strong, very strong in the Q1 because of the earlier booked orders. The sales from EPC department division vertical is rupees 211 crore as against 396 crore in the previous period. So this has declined significantly, mainly because of the execution issues in the first 3 months of April, May and June, and in the second quarter also execution issues were there because of the heavy rainfall all over the country. So restricting the activity at open sites. Pending order position as on 31st October 2020 is rupees 2,663 crore. So in this, EPC orders are domestic 621 crore, EPC export is 562 crore, 358 crore. Extra high voltage cable turnkey projects 562 crore, cables domestic 1026 crore, and cable exports pending orders are 96 crore as on 31st October 2020. As mentioned earlier, the company has bagged its first big order of 400 kV voltage grade of rupees 148 crore from Tamil Nadu Transmission Corporation Limited. With the receipt of 400 kV EHV cable order, company has reached another milestone and has placed KEI amongst the few international players in the industry to manufacture and supply cables of this level of voltage grade, which is the highest voltage grade in the insulated cable segment. I'll come to capex now. We had undertaking a new project of manufacturing house wire and flexibles for increasing our retail segment. So the total cost at Chinchpada in Silvassa, the total cost of Chinchpada expansion will be around 90 to 100 crore. The first phase is already operational, and we have spent approximately rupees 74 crore till 30th September 2020. I will come to the little bit of finance side. During first half, finance cost has in the H1 of 2021, the finance cost has decreased to rupees 31.74 crore as against 68.50 crore in the previous year same period, primarily due to decrease in the debt. Percentage of financial charges on net sales has decreased in this period to 1.78% from 2.96% as against same period last year. KEI credit rating from ICRA and CARE has been upgraded to A+ for long-term rating and reaffirmed at A1 for short-term rating. Now, I request all of you to raise any questions you may have in this regard. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Lavina Quadras from Jefferies. Please go ahead.
Hi sir, congrats on a good set of numbers. Just two questions I had. One is your EBITDA margins have done very, very well. I understand it's a mix of cost changes as well as product mix, but I just want to understand how much of the cost cut measures you all have taken, how much of that do you think will come back, just to understand where margins can normalize at? I mean, versus 11.5, does it settle on a full year at this 10.5 number, or can it actually go closer to 11? Because some of the cost cut initiatives will be temporary, I'm guessing, because of the lockdown. That's one. Secondly, sir, on working capital, there's been a bit of a stretch. I understand the industry is still normalizing, but particularly on debtors, I mean, has it gone up because of institutional primarily? So just to understand a bit of that, and when do you see that easing off? Thanks.
See, the working capital cycle has improved in wire and cable segment. It is increased because of mainly the high debtors in EPC segment. So we are, I would like to give a guidance that we are working on reducing our EPC business from here onwards, and we'll be cutting it down from earlier levels of 1,000 crore per year. We will be restricting this business to 500 to 600 crore from here onwards or in subsequent years, because the main problem is that the payments are delayed by state governments and departments, and which leads to higher debtor level, and also the 10% retention money which is stuck for various projects is very slowly coming. So we are hopeful that we will be able to recover 250 to 300 crores of stuck money and a substantial amount of retention money of earlier executed projects which are already closed by March, which will improve our working capital cycle and also will bring down the debt further, almost reaching to zero debt level. So our future working will be more towards cash flows, and will be putting that money into retail segment and focusing on increasing the retail by recovering the cash from the EPC.
Okay. And sir, on margins?
Margins as of now, I can definitely give a guidance of around 11% on a full year level, and we will try to improve upon it.
Good. And so last one, could you please give a breakup on the interest cost, like term loan and working capital and LC, if available?
Hello. Yes, Lavina ji.
Yes, sir. Just, yeah.
In the first half, the interest on term loan is 2.5 crore, and in the interest on working capital is 13.6 crore. LC interest is 7.4 crore, and bank charges on LC is 2.8 crore, and bank charges on bank guarantee is 3.6 crore, and processing fee is 1.74 crore. So put together all is 31.73 crore.
Okay, sir. Thank you.
Thank you. The next question is from the line of Dhruv Bhatia, an individual investor. Please go ahead.
Hello, sir. I see that
Mr. Bhatia, can you take the phone off speaker, please?
Quarterly basis from...
Mr. Bhatia, request you to please take the phone off speaker, please.
Yeah. Hello. Am I audible?
Yes, sir, you.
Yeah. I see that our order book is reducing on a quarterly basis, which was around 3,400 crores a year back. We are to around 2,600 crores. So what is the major reason for that?
I have mentioned that we are reducing the major order backlog of high value is always from EPC orders. So we are reducing our dependence on EPC. That is the main reason. But our order book in the wire and cable is maintained, and you can watch from our earlier conference calls also. That figures are maintained. But EPC business figures are reducing because we are reducing our order intake into that division.
Okay. Secondly, we see that like in the housing and wires, so on the retail end, what kind of wires do we sell as of today, apart from the house wires?
We are selling house wires. We sell single core flexibles, multi-core flexibles. We sell panel wires, and we sell coaxial cables, telephone wires, and data cables.
So are these categorized under LT cables?
No, this is where you are categorizing.
Sorry?
No, whatever house wires to the retail segment, we are selling the house wire segment.
Okay. Apart from that, what do we sell in the retail in terms of our major heads?
We are selling LT cables through our retail segment, as well as mainly it is house wires, flexibles, LT cables, and winding wires. Winding wires for agricultural pumps.
Okay. And lastly, with the reduction in EPC business that we are looking forward to control our debt and working capital cycle, what kind of growth do you see going ahead in terms of top line?
See, we will be able to, pardon?
She wants the retail growth.
Retail, we want to take the retail to 40% level of our turnover. And this year, we expect that in the coming quarters, we will be able to maintain our sales. But growth in the because last year our base itself was very high in the quarter 3 and quarter 4. Our turnover was quite high, and projects at this moment are not that big. But with lot of new opportunities are coming up, and we will be able to build up our order book and grow the sales in the next year by at least 15% level in the next financial year.
Okay, so we can say that excluding FY21, we will maintain a 15% run rate for the next at least 3 to 4 years from FY22 onward.
Correct.
Correct?
Yes.
With minimum of 11% EBITDA margin.
Yes.
Okay, sir. Thank you.
Thank you. The next question is from the line of Andre Purushottam from Cogito Advisors. Please go ahead.
Yes. Congratulations for a decent performance and coming back to near normalcy level. I just want to do a follow-up question on the margin, EBITDA margin that you're having. Going forward, some of the savings that you've had, this is maybe COVID related, right? Like less travel or work out of home, etc. So how much of this will be sustainable? The second thing is that with your increasing emphasis on the retail sector, I'm assuming you will resume your expenditure on brand and advertising, etc. So how do I see, if I look at various aspects here, go back to increased advertising expenditure, some element of retention of your COVID savings, and some element of product mix. If you could just spend a little time of this in terms of your margin implications going forward, it would be useful.
We will be able to maintain our margins because mainly by cutting down the interest cost, by freeing the money from the EPC debtors and putting that money into retail segment. So that will lead to reduction in the finance cost. So whatever expenditure will be incurring on brand promotion and advertising or etc., that will be covered through that.
Shottamji, brand building, we are already doing the expenditure because in this quarter the IPL expenditure is also there because IPL we have participated in the fifth row in the fifth year in continuation. And as far as the traveling expenditure is concerned, slightly it will increase because in the first 2 quarters very less travel expenditure. But at the same time, the proportion of sale will also increase. So in terms of percentage, it will not get much affected.
Right. So, supposing the travel expenditure normally used to be 100 and has come down to 50, let's say, I'm just giving some figures. Some of it will come back, but is it possible that your travel expenditure and even some savings from work from home will remain permanent going forward?
Yes. There will be definitely, because now lot of we have now developed new habits. Lot of customers, I think 80-90% of the customers have now developed habit of doing virtual meetings. Even our internal meetings, we used to call people from our different branches for discussions and etc. That also we are now changing our habits. Instead of calling them, we are doing virtual meetings.
Right.
Even we are doing regular virtual meetings with our dealers across the country. So basically it has brought a change in our habits and working pattern.
Right. So, and how about work from home? Will that continue, or will some of that continue going forward, or after the pandemic?
I think that will be just 10 to 20%, not more than that. Because we are not a financial services industry or IT industry. We need physical presence to do the work.
Okay. Thank you, sir. Thank you. And congratulations again, sir.
Thank you.
Thank you. The next question is from the line of Saurabh Patwa from HDFC Mutual Fund. Please go ahead.
Good afternoon, sir. Thanks for taking the question. So just wanted to understand, so since you're saying that since we now plan to reduce the business from EPC, so this will also result in lower cable sales, which were part of the EPC project. So, and that EHV business, as you had highlighted earlier, is largely is EPC. So does it also mean that large part of non-EHV EPC business would be done away with?
No, we are not going to reduce extra high voltage cable turnkey business. That is our core activity, where 75 to 80% value of the project order value is cables.
Exactly, sir. Exactly. That is what
so we are not going to reduce that. We are going to reduce which we categorize as EPC business, where our cable portion in the distribution segment, where our cable portion was only 25 to 28%. That and rest is distribution strengthening, like installation of transformers, installation of poles, etc., rural electrification. That business we are going to reduce. And let me mention that transmission utilities all over the countries are very good in payments, and their projects are executed well before time and in very short duration, and there is no stock of retention payments in those segments.
Understood, sir. And does it impact our the original capex plan in some way, or that whole project is?
No. Our capex plan for new projects is well on the card. It's just delayed by 9 months to 1 year because of the pandemic. This whole year is a washout. We were searching for a lot of lands, etc., in Gujarat, which we will be starting from after Diwali, and we hope to finalize it by January. So we will start building up the new project, maximum in the next financial year from March or April, or the next year, March or April, we'll start building up the new project.
Great, sir. And sir, in terms of when you say that we are increasing focus on the wire segment, and we are also putting some capex for that. So, any plans on how we plan to strengthen our distribution network? Any specific area which you believe we have more scope to do things and something of that sort?
See, we are working on it on pan-India level. Now, one is that we are strengthening and reviewing our teams in various branches who are focused on retail network, and we are reviewing their activities, monitoring their movement, their footfall to the dealers, and reviewing the retail schemes, and this we are doing on the pan-India level, ensuring that our stock levels in depots are supply chain is completely in place all the time. So we have seen, I can't talk of October, but we have seen substantially improved results in retail sale in October also, which is highest ever sale ever achieved in the company in the wires and flexible in October. So that is showing the trend that what actions we have taken, that is going to bring improved results in this segment.
Just last question, just related to this, you can just add. Would this uptick which you are seeing, would you term it as market share gain, or is it the market itself is growing very sharply?
I won't say that market. I don't know the estimate that whether market is growing very sharply, or I don't know whether it is definitely some proportion may be market share gain. But the second aspect to it is that we are entering into unrepresented areas where our presence was not there. So we are making dealers in tier 3 cities or even smaller cities and doing good penetration in the rural areas. So we are basically increasing our sales in the unrepresented area.
Right. So essentially it is market share gain only, sir.
Correct.
Great, sir. Thanks a lot.
And also, I think we have seen, we expect that unorganized market share will also be going down in year after year.
Great. Okay, sir. Thanks a lot, sir.
Thank you. The next question is from the line of Vikas Kemani from Carnelian Capital. Please go ahead.
Hello, sir. How are you?
Good, Vikas.
I just had a couple of questions. I think our KEI brand is pretty strong, and it's been kind of household name. We have a reasonably large distributor network of almost 1,500 dealers and all. So do you have any thought, and especially now the attention on the EPC business is going down, any adjacent category on the consumer or retail side where we would like to organically or inorganically get into? Because many companies have grown in the past, whether it is Polycab or whoever else, by going into adjacent markets when they have especially strong brands. So is there a thought process you can share on that?
Yeah. Now we have started conceiving that idea, and we are working on adding new retail products which can be serviced through our established dealer network, whether from the same dealership or like-minded dealership who caters to this consumer durables or other type of electrical products. So, but we are in the very initial stage of working on this. I think it will take another 4 to 6 months to crystallize and launch further, when we will be able to give a definite outlook on this for the next financial year.
And secondly, sir, on the exports front, because I think historically we have also done reasonably well on the exports in the last 5-7 years. So, and especially given the change which is happening in the current environment on the export, do you see any specific increased momentum on the export side, any change you are seeing in the environment on that, and any specific target you have in mind on that?
Exact numbers cannot be predicted, but we are definitely seeing a shift towards India because of the problems in China. And many countries are trying to develop alternative sources for their imports. But it will be more visible in maybe after. We will be able to give some more picture after 3 to 4 months, because the problem at the moment is we are not able to travel anywhere. There are complete travel restrictions. No flights are going. So and we are also restricting our movements, and ourselves and the staff as well. So this is the reason that it will take. I think by this end of this financial year, we'll be able to give some picture out of it, and there will be definitely a shift.
Okay, sir. Thank you.
Thank you. The next question is from the line of Hiten Boreja from Sequent Investment. Please go ahead.
Good evening, sir. Thanks for the opportunity. So you mentioned that we have you mentioned something about capex, that we have stopped the capex due to this pandemic issue. So what is the capex guidance for FY21 and 22, and what was it earlier?
Next year, our capex, planned capex was around 150 crore in this year. So now it will be done in the next financial year, and we will plan to do similar capex for next 2-3 years to build up a new greenfield facility.
Okay, so 150 to 200 crores of capex for next 2-3 years.
Yes.
Is that right? Okay.
Yes.
Okay. Thank you. That's all from my side. Thank you.
Thank you. The next question is from the line of Sparsh Raina from Mirabilis Investment. Please go ahead.
Hello, sir. Thank you for the opportunity. Sorry, I joined in the call late. Could you just let me know what are the sales for domestic and retail sales for this quarter? And also product-wise?
Product-wise sale you can write now. You can note down in the Q1, the low tension power cable is 390 crore, and high tension power cable is 148 crore. Extra high voltage power cable is 102 crore, and house wire 227 crore. Stainless steel wire sale is 33 crore, and EPC sale is 133 crore rupees, and balance and the miscellaneous is 4 crore rupees.
Okay. Sir, and on domestic and retail sales overall? Like exports we have given and
Overall Q2 retail sale was 348 crore as against 355 crore last year in the same period.
and domestic.
And domestic sale was 544 crore versus 651 crore last year. This includes all institutional sale of domestic, including
Sir,
EPC.
and okay, sir. Sir, in terms of the order book,
Export sale was 160
order book
versus 235. Export sale was 160 crore versus 235 crore last year.
Sir, order book, sorry.
Order book was 2,600 crore at the end of 31st October.
So in that segment wise, in terms of EPC, cable, export, EHV.
In terms of EPC, domestic order was 621 crore and EPC export order is 358 crore rupees. And extra high voltage order cable is 562 crore rupees. And our domestic institution cable order is 1026 crore rupees. And the cable export order is 96 crore rupees.
Cable order is? Sorry, 96 crores. Okay, sir. Okay, sir.
So all is 2,663 crore rupees.
Okay, sir. Thank you. Thank you, sir.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity. So, sir, I just want to understand now this reduction in the EPC, revenues, how we would be able to compensate, either through exports or increase in the domestic sales, which particular, segments, be it low tension or high tension, can, offset this reduction in sales?
We'll compensate it mostly through the increase in the retail sales and maybe to the extent of 75%, and balance will compensate it from the sale of wire and cables in B2B segment and extra high voltage cables.
Okay. So, sir, from the retail sales perspective, now you had earlier talked about, increase in the distribution reach. So, can you give some number in terms of the touch points, what we are adding now in the coming time frame? What was our earlier run rate and what we are going to add in terms of how the distribution reach is going to expand?
I mentioned that we have a dealer network of 1,600 dealers pan India. So we will be adding around 200 to 300 dealers in this financial year. But more than that, we are, helping our dealers to increase their sub-dealer retailer network under them to improve the distribution. That is another activity which there we are increasing indirect retailers attached to our dealers so that our touch points increases.
Okay, sir. And on the B2B business, generally now, how is the pipeline looking like, on the tenders or the overall, government ordering in the second half from different end markets?
We are witnessing a good vision and good growth in that, and we are hopeful that we will be able to achieve our targets of B2B business from the domestic segment.
Okay. Great, sir. Thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Mayank Bhandari from B&K Securities. Please go ahead.
Thanks for the opportunity. Sir, I just want a clarity on the export number for Q2. Can you help me with that? Export number for Q2.
Yeah, total export in Q2 is 160 crore.
And sir, H1 you had told how much? H1 total?
343 crore.
So sir, it means because Q1 number was 163 crore. So has the Q1 number restated or?
So cable export as well as the Dangote cable was separate, no?
Okay.
Yeah, including that was to 343 crore.
Okay. And sir, for the full year, like any guidance for the finance cost as percentage of sales?
Finance cost will be in the same ratio, the way it is going on.
Okay. And sir, we have seen uptick in the house wire sales after 2 quarters. Like last quarter was like 40% decline, and 4Q was also 14% decline. This quarter it seems like it a growth of 3-4%. So any particular comment like how we are seeing the residential construction uptake, or any particular comment for that in different?
Sir, Q1 was declined because of the lockdown by at every level, including dealers. So when nobody was working, how the sale will come? In Q2, we have achieved around 98% of the sale of the last year level. So in spite of partial activities at all over the country. So I think this 98% achievement is at par with all most of the similar companies in our segment.
Okay.
I think future it will grow actually in the next quarter.
Future balance quarters it will grow further.
So I can assume like next 2 quarters it will grow only.
Yes, it will grow only.
Sir, lastly, what is your L1 position as in terms of order? EHV L1 or any?
नहीं अभी कोई L1 में नहीं है.
अच्छा. Okay, sir. Thank you.
Okay.
Thank you. The next question is from the line of Ankit Babil from Shubhkam Ventures. Please go ahead.
Good evening, sir. Sir, my first question is, what is the current retention money pertaining to EPC business in the balance sheet?
It's close to 290 crores.
So 290 crores, and this would be for a business of 1,000 crores. So,
yes.
So when you're targeting that 500, 600 could be the new run rate for the EPC business, which is almost 50% of the current run rate. So you believe this retention money will also come down from 300 to 150 crores on a run rate basis?
Yeah, sure. Actually, in the current financial year, the receivable of EPC will come down another 250 to 300 crore. So that's why the CMD has told that the cash flow will further improve. The working capital cycle will further improve by the March end, and all our cash flow we will put into the retail sale for growth for the next financial year and for the balance 2 quarters.
Invest in the sense in the capex part?
No. Capex part is separate, but we are saying that right now we were not aggressive in the retail, like by giving the credit to those dealers. But now we will go aggressive, and so that we can invest more into the retail side, whatever money we will be having in hand. You see, at present, if you see our balance sheet, we have repaid almost to 400 crore to the creditors. That's why the working capital cycle look like high. But if you consider that if we were हम लोगों ने वो नहीं पे किया होता, तो working capital cycle क्या होता? तो almost 1 month वैसे improve होता. क्योंकि we were having the money, that's why we were buying the on cash purchase.
Okay. So my question, another question is that this 500, 600 crores of EPC business which you plan to continue, so will EHV be part of this, or EHV would be in addition to this?
EHV is always separate.
In EHV business, the execution portion is very small, not more than
80% is cable.
Yeah, 80% is only the value of the cable. 7 to 8% is joints and terminations, and only 10% is the execution portion where we have to dig and insert the cable. So it's a very small area. Each EHV cable project is spread in a very small area of maximum 5-6 kilometers. Unlike a EPC project of distribution, which is spread over 400-500, each project is spread over 300 to 400 square kilometer area. So the manpower requirement in executing a EHV project, we just need 1 or 2 engineers at site. That's all. Not a big team. Our total EHV business, which we have only 50 or 60 people for execution all over the country, and some 30-40 jointers. That's all.
Okay. So just a clarification, you did mention that the working capital which would be released from this EPC business would be deployed to aggressively grow the retail business. So now, so is it fair to conclude that the throughput would be higher in, now onwards, because, the working capital requirement for a retail business is fairly low as compared to the EPC business, and even the margins are also higher. So for the company as a whole, the throughput will be higher with the same amount of money.
Yes.
Is it a fair conclusion?
Yes, much better. And moreover, cash flow which will be freed will reduce the debt, and also the working capital cycle will improve.
Okay, sir. Great, sir. But sir, do you okay, fine. I am through, sir. Thank you, sir.
Thank you. The next question is from the line of Forum Makim from Equity Capital. Please go ahead.
Hello, sir. Congratulations on a strong recovery. I just had two questions. So, are the employee costs back to the pre-COVID levels?
Yeah, employee cost, whatever has reduced, it was reduced because of the EPC project was closer. So it is mainly because of that. Otherwise, the employee cost, the run rate will be same as you are seeing from the second quarter.
So what will be the run rate?
Whatever second quarter employee cost is there, the same you will see in the balancing quarters, third and fourth quarter.
Okay, sir. And how would we fund our CapEx?
CapEx from the internal accrual only.
Coupled with reducing our debt.
Yeah, reduced because debt has already reduced, and hardly 148 crore net debt is in the balance sheet as on 30th September. You are seeing, as CMD sir has explained, that approximately 250 to 300 crore recovery will be from the EPC receivable. So that money we will put into the working capital, and whatever the cash accrual will be available, it will be used for the new capex in the next financial year.
So sir, would we be debt free by the end of this year?
Yeah, it is almost, it will be the debt free.
Okay, sir, just one last question, sir. What is the outlook on our order book? Like, where are you seeing the demand from? Like, where is it coming from?
You see, the order book in the cable business since last 8-10 years, we are maintaining only 3 to 4 months order supply, because in cable, only in extra high voltage we are having the order book position to 5 to 8 months. But normally for low tension, high tension or export cable, order book always maintain only for 3 to 4 months supply.
That has been historically the same. And the order book, what we receive is from metro projects, railway projects, all sort of projects, be it power segment, power distribution and transmission side, industries, infrastructure, construction sector. So whatever sectors are there traditionally, the same sectors, actually the cable demand comes from sectors of economy.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Hi, congratulations for a good set of numbers, sir, and thank you for giving me the opportunity. I have a couple of questions. First, last year in EPC segment, we did a 760 odd crores of revenue. Can you help us? What portion would be the EHV portion for this EPC segment?
Out of 767 crore, close to 130 or 140 crore was EHV, and balance was the EPC transmission and distribution.
Okay. And as you mentioned that you would be reducing the 1,000 crores to 500 crores, so that would also include cable business as well, right? When you say 500 crores.
Out of 500 crore, close to 125 to 150 crore is the cable portion. That in any way we can generate from any institutional sale, because we have a very large institutional clientele in our hand.
Okay. So that means you would be ramping up this business to close to around X of cables would be around 350 odd crores. Would that be the correct number to work with, sir?
Repeat your question.
Sir, as you mentioned that almost 130, 140 odd crores is the cable business. So EPC business X of cable
for
would
the
be
for the 500 crore sale of EPC.
for the 500 crore cables. Okay. And second thing, sir, you had
Yeah.
second thing you mentioned that you will be aggressively looking at retail as a segment. Would you be able to just give a sense on what kind of overall dealer network strength the industry has? As you correctly mentioned that you are around 1,600 dealers, but all over India, what is the strength of the dealer network, and which of the geographies are you looking, or which states or regions are you looking to strengthen your dealer network over the next, let's say, couple of years to reach whatever the target of 40% retail contribution you are looking at?
Harshit, we are looking all over India basis. Though our north is very strong in west and the western part is very strong. So now we are more working towards the east and south part. So wherein we will be adding more dealer distributors as well as strengthening the existing dealer distributor network. The all over India dealer distributor figure we are not having actually.
Okay. But would it be correct to say we are at least around 30 to 40% of all India distribution? If you are getting a sense, anything on that? That would be helpful.
Our dealer distributor strength is very less as compared to our peer group of Polycab, Havells and RR Cable, because they are working in this retail market since last 25-30 years. We are working only since last 9-10 years.
Okay.
So far way to go for us and lot of scope for us. That's why we are releasing our money from EPC to put into the retail market.
Okay, sir. These were my questions and all the best, sir.
Thank you, Harshit. Thank you.
Thank you. The next question is from the line of Manish Agarwal from Edelweiss. Please go ahead.
Hi, sir. Just a couple of questions, sir. About the capacity expansion, since we're talking about 150 crores per year from maybe next year, FY22 onwards. So, sir, by when can we expect this capacity come on board? And will it be largely cables and stainless steel wires?
Manishji, the capacity expansion only will be for low tension, high tension and extra high voltage power cable, because house wire capacity we have already completed in our Silvassa Chinchpada plant, and almost 150 crore to 175 crore we will be spending year on year basis to maintain the growth of 15 to 17% per annum. Because whatever capacity we are having, almost close to 4,600 crore is the manufacturing capacity and 1,000 crore was the EPC. So this kind of manufacturing capacity already we are having. So we are having almost the next financial year capacity available with us to grow further from here to close to 15%. But from the 22-23 onwards, to improve the sales, we have to put the new plant. So that's why CMD sir explained that we are going to acquire the land in the third quarter itself, and we will start expenditure for the capital for low tension, high tension and extra high voltage power cable.
Okay. So basically by for FY22 we will have this capacity ready basically.
Yes. In 22-23 it will be available.
Sir, just one clarification, sorry to repeat the question. If you could please give the order book breakup once again.
Can you repeat the question, please?
Sir, just if you could repeat the order book breakup, the 2,600 crore order book, if you could just give the breakup.
Yeah.
And the EPC domestic order book was 621 crore rupees. EPC export was 358 crore rupees. Extra high voltage power cable order book is 562 crore rupees. And domestic institution cable order is 1026 crore rupees. And cable export order is 96 crore rupees. This is as on 31st October.
Yes. Okay.
Thank you. Over to the management for any closing comments.
So I thank all of you to join our investors conference call, earning calls for Q2. If you still have any queries, you may write to us or you may talk to us, and we'll give you relevant clarification. So thank you very much for joining us this evening, and have a good evening.
Thank you very much to all.
Thank you. Ladies and gentlemen, on behalf of Edelweiss Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.